I'm Elisa Parenti from Washington, and you're watching Bloomberg Technology. Let's start with a check of your first word news. President Trump says the United Nations has tremendous potential, but that it hasn't been used over the years nearly as much as it should be. The president spoke during a meeting at the White House with UN Secretary General Antonio Guterres today. Mr. Trump also praised Guterres' leadership in the organization. Damage estimates from California wildfires are rising. Officials said today 7,700 buildings have been destroyed by the blaze. The number has gone up as crews assess damage from the series of fires that broke out earlier this month. The fires have killed 42 people and caused more than $1 billion worth of damage. U.S. House Speaker Paul Ryan says the Republican tax overhaul plan includes a fourth income tax bracket for the wealthy. It hasn't been decided whether the top bracket will remain at the 39.6% rate. Ryan says the tax bill will be finalized in, quote, a number of days. It's been 1 month since Hurricane Maria devastated Puerto Rico, and only about 20% of people on the island have power now. Governor Ricardo Rossello is pledging to get that to 95% by the end of the year. The hurricane struck at a bad time. The Electric Power Authority there filed for bankruptcy. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg.
Chang, and this is Bloomberg Technology. Coming up, S&P 500 on a 6-week winning streak, and tech helping to ignite the boom. But is it sustainable? We'll identify potential headwinds on the horizon. Plus, tech IPOs are back on the menu, with Southeast Asia's most valuable startup leading the charge in New York. We'll look beyond the summer slump to the next hot Silicon Valley company at the gates. And tech earnings on tap, with major players lining up reports for next week. We will preview the biggest companies. But first, to our lead. U.S. stocks close out Friday's session at record highs, new record highs, this capping the fourth straight positive week for the NASDAQ. So what, if anything, can slow down the gains in tech stocks? Michael Regan, editor of Bloomberg's Markets blog, MLive, and David Kirkpatrick, CEO of Techonomy and our guest host for the hour, join us now from New York. So, Michael, start with you. Does this tech rally still have room to run?
Well, I think if you look at the forecast growth rates for your main tech companies, they're so strong that the valuations almost seem reasonable in most cases. I like to look at the PEG ratio, which basically compares the PE ratio to the long-term forecast earnings growth. And if you look at anyone from Facebook to Apple, Google, they all look very reasonable. Now, Amazon's kind of an outlier. There's not many. I don't think you can find a valuation metric where Amazon looks cheap. But these high valuations aren't necessarily scary when you look at these forecast growth rates. I think the one risk people are talking a lot about now is regulatory risk, especially with these hearings coming up on Capitol Hill about Russia's involvement with Facebook and Google and Twitter during the election. That's a risk. I don't see it being a very big risk to their business, but I do think it'll be something interesting that a lot of people will be curious to see how it pans out.
On that note, David, as Facebook and Google, of course, Twitter get ready to appear before Congress, that hasn't seemed to impact the business at all, yet they're answering very serious questions about Russian meddling on their platforms, the advertising model, as well as fake news.
Yeah, I've been somewhat surprised that there hasn't been any response from Wall Street whatsoever on the regulatory scrutiny that's being directed at Facebook and some of the other companies. But I will say, I think the Russian thing is just the tip of an iceberg. The real issue has to do with the nature of targeting on Facebook and really whether or not it is a media company or not, given that it's funded by advertising, and it essentially will allow any ads to run that somebody wants to pay for. Now, if that were to change, it could affect Facebook's revenues. That could affect its profits and its valuation over time. The question is, what is the scale of any of these things? And they're very hard to really analyze from here, but I think there will be economic impact of the regulatory onslaught. It's not just scrutiny. It is a building onslaught facing Facebook and Google in particular.
And that, Mike, will be in the spotlight on November 1st. Do you think we'll see, a reaction in the stock as we get closer to the time?
Well, obviously, I think it all depends on what comes out of those hearings. It's all the lawyers for the companies appearing, so it's, the CEOs aren't on the hot seat. And I'd be curious to see if Congress says, hey, we do want Mark Zuckerberg here, we do want the CEOs here to hear their side of the things. I think, a lot depends on how these lawyers perform, if they give Congress the information they need, if there's any surprises that come out from the hearings. But I really think Russia is just one of several regulatory risks that you have to look at when it comes to big cap technology. Obviously, President Trump has made it no secret that he's not a big fan of Jeff Bezos and Amazon, and feels that they're not paying the taxes they should. Some lawmakers at least have brought up the idea of antitrust when it comes to Amazon. You read what the antitrust experts have to say, and it doesn't sound like there's a strong case for that, because they're not dominating any single business within retail. They're not dominating the cloud. But we do have a president sitting in the White House who is made it no secret that he's not a fan of the company. So, if I were to pluck out one sort of major regulatory risk for any of these stocks, I would maybe look at Amazon, especially because it has been sort of ignoring valuation metrics. Investors don't care what its PE is. They don't care what its price to sales is. They're in it for the long haul. They're watching Amazon grow sales and grow market share. So it's an interesting time for them to sort of come up against that sort of risk.
Amazon, that has been the story of the company for the last several years when it comes to investors, and the Amazon Whole Foods deal didn't get any scrutiny at all. David, Mark Zuckerberg and Sheryl Sandberg will not be testifying before Congress, because that is also the day that Facebook is holding its earnings call on November 1st. Of course, we've also got Google earnings coming up. Do you expect to see any impact on the actual business, when we look at the numbers for this quarter?
I don't expect to see any impact on the numbers for this quarter to speak of. I absolutely, as I said before, think we will see economic impact on these companies, and particularly Facebook, long term. I happen to think it's a mistake for Zuckerberg not to be appearing before the Senate Intelligence Committee. I think to send the lawyers is diminishing the significance of this investigation. I would almost take a bet that within 6 months, Zuckerberg is going to be testifying in front of Congress in some fashion, probably Larry Page as well. That just is the way things are headed.
So Mike, next week, what are you going to be looking for? We've got a raft of tech earnings coming out. What are you going to be looking for when it comes to these stocks?
Well, I think when I look at big cap tech, obviously far and away the leader of the stock market this year. S&P Information Technology Index is up 30-some% for the year. Facebook's up like 52%. There do seem to be some jitters around these stocks. We've obviously seen some pretty sharp pullbacks in tech stocks this year, only to see them sort of V-shape recover very quickly. But the market is kind of on edge for whether this whole theme of reflation, higher inflation, higher interest rates will really take hold. And that could sort of cause a little bit of a rotation in the stock market. I'm not so sure it would cause a big drop in tech stocks, but it might sort of cost them that leadership position in the market. Investors seem to be on edge to trying to decide whether it's a good time to rotate into the more value stocks, your financials, energy companies, your more cyclically oriented stocks, and out of tech. So that's been sort of a back and forth drama that we've seen all year, and I suspect it'll continue.
All right, Mike Regan, our markets editor. I know you'll keep us surprised next week. David Kirkpatrick, CEO of Techonomy, you are sticking with me. Well, U.S. stocks were not the only thing setting a record on Friday. Bitcoin also closed at a record high, at one point crossing $6,000. The digital currency has now gained nearly 500% in 2017 as investors continue to shrug off the potential for increased regulation. Coming up, are tech stocks overvalued? We'll pose the question to Light Street Capital president and founder Glen Kacher. That is next. And Bloomberg Technology is live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. stock we are watching, PayPal rose to a record after beating analyst estimates for earnings and giving a strong forecast for the end of the year. The digital payments company has been campaigning to expand the service beyond websites and is getting a boost as more retail stores seek to compete with Amazon. PayPal also said Friday that users can now send and receive money via Facebook's Messenger app. Well, Tiger Cubs, protégés of hedge fund legend Julian Robertson, are some of the hottest hedge fund managers around, and many have become influential tech investors. Light Street Capital's probably the hottest of all right now. This year, the fund is up about 50% thanks to stakes in tech giants like Uber, Facebook, Amazon, Netflix, and Alibaba. Earlier, Bloomberg Technology's Alistair Barr sat down with founder and president Glen Kacher to ask if this tech market boom has gone too far.
The trends, the major trends the largest tech companies are taking advantage of, going on for many years. And it's still early in the penetration of, for e-commerce and mobile e-commerce and all the things that drive Facebook and Amazon and Netflix and Google. And while the stock prices have done incredibly well, those prices really haven't kept up with fundamentals.
And what about things like this Russian ad investigation? That there's been a lot of headlines. We've been writing a lot about it for Google and Facebook. Is there anything involved in that gives you pause about the way these companies make money, the way they sell ads?
Sure. There's always, look, in the new technology and especially with self-service and all the efficiency that brings, there are risks, business risks that come with that. And so we've seen in the past, if you look back to Google as it was growing up and eBay as it was growing up and growing into its teenage years, that there were challenges with people listing items for sale that were not appropriate for that community. Or with Google, there was click fraud, and there were verticals and industries that they didn't particularly want advertising on their site. So they had to find a way to filter those things out and to protect both the buyers and sellers on the sites from that kind of behavior. And particularly when we look at this, at the Russian controversy, you look at the amount of advertising that was spent by these Russian sources, and you compare that to the total advertising that was done on the site and political advertising by all sorts of official channels in the United States, and it's just a small fraction. And so I think this is something that over time the companies can adjust to and can block from the site.
And now Light Street also invests a little bit in private companies, and I wanted to ask about Uber, that they're in the middle of possibly a very big deal with SoftBank. Lyft just raised a lot of money. How do you feel about Uber right now and ride-hailing in general?
Sure. So ride-sharing is incredibly early. I was just speaking with someone from General Motors, and by their measurements, ride-sharing is only about 0.1% of miles driven in the United States. And you look at the amount of value that Uber and Lyft have created in those businesses, and we're at a 0.1% penetration. That's just tiny. And so the ability for these businesses to grow 100x from here is very, very real over a decade or more. So the runway in front of us is tremendous.
And I know that from what we know of SoftBank and that deal that might be coming, they're going to put some new money in there, but they're also looking to buy some Uber shares from existing shareholders. And I'm wondering, so I assume you wouldn't be selling to them? No,
well, our shares are definitely not for sale. We'd be buyers on this price. We'd very much like to increase our investment in Uber. Uber is the dominant ride-sharing company in America for sure, and I think they've rationalized their spending both here and abroad. And we think it's going to be a tremendous investment opportunity, even from the valuations that are being discussed today.
And what about when you just look on the surface at how much they're losing, even though they've cut some spending internationally? Do you think at the core there's a very profitable business in there?
For sure. They're in real time matching buyers and sellers in a market that's absolutely massive. And I think that we're just scratching the surface. Today, we're all using Uber and Lyft as a way of adding. It's an incremental demand. It's adding on to our transportation options. But as the millennials grow up, and as we all get, our cars get to be to the end of their lives over the next 7 or 10 years, I think people are going to make different decisions about whether they buy a primary car and certainly a secondary car, and how they use ride sharing to fill in those opportunities to get around.
And what about, there's a great tech investment story that you are following. Are there any tech companies that you feel kind of less enthused about, or any companies that are losing out from some of these trends?
Well, sure. I mean, I think the great thing about the tech industry as a hedge fund is that there's always creative destruction, and it's not always market share. It can be market opportunity, right? So I think one example that I would give is you look at the rental car industry, and I think when we've done a tremendous amount of work actually talking to business travelers and consumer travelers about their intention to spend on rental cars going forward, and many of them, when they can, they will use an Uber or Lyft to replace rental car transactions and days that in the old days they would go that way, and this is a real opportunity for Uber and Lyft to take market opportunity.
Light Street Capital President Glen Kacher there, speaking with Bloomberg's Alistair Barr. Coming up, another day, another tech IPO. We'll discuss why there is a surge in activity after a quiet summer. And a feature I'd like to bring to your attention, our interactive TV function. You can find it at TV Go on the Bloomberg. You can watch us live. If you miss an interview, you can go back to it. You can send our producers a message, play along with the charts we bring you on air. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg. After a sleepy summer, IPOs are coming back. Southeast Asia's most valuable startup, Sea Limited, raised about $884 million in its initial public offering in New York today, trading under the ticker SE. This after another debut from database software maker MongoDB earlier this week, which rose more than 30% in its first day of trading. David Kirkpatrick, CEO of Techonomy, still with us. So looking at this particular company, Sea Limited, David, this is a company that licenses games from Tencent. What's your take on the optimism here?
Well, if a company can replicate the success that Tencent's had in China in other parts of Asia, which seems to be the basic gamble and more or less success thus far with Sea, it's a good guess. It's a good bet. I mean, Tencent owns a big chunk of this company. Tencent really invented a lot of the model that has begun to prevail in gaming in Asia, where you play games and then you buy for free and then you buy add-on things. That's what Sea does in Southeast Asia. They also have other businesses like commerce business and others. Gaming is the primary. I think it's a very fast-growing arena, online entertainment. If you have Tencent's endorsement and encouragement, you could not have a better ally.
Now, looking out over the next few months, it looks like there are more tech IPOs on the calendar after a fairly quiet summer. I mean, should we read anything into the slowness of the pipeline up till now?
Well, I think there is some ambivalence about whether it's the right thing to do among many CEOs of startups, many of whom are strong companies that sort of like the idea of not having Wall Street breathing down their neck. But, the investors in the end tend to prevail. And I think you'll just see a lot of pent-up, a lot of companies that may have been dragging their feet, which Facebook did, by the way, for a long time, will end up going public. There's a lot of great companies beginning to go public now, and I think that might also shift the psychology. MongoDB is a great company, for example.
Meantime, Stitch Fix has also filed for its IPO, and we finally now have a look at the numbers. Our Bloomberg Gadfly columnist Shira Ovide called it the anti-Silicon Valley startup. It is profitable. It's quiet. There is no drama at this company. I spoke with Katrina Lake, the CEO of Stitch Fix, about some of their revenue numbers a few months back. Take a listen to what she had to say.
I focused really early on unit economics and making sure that we were going to be in control of our own destiny. And so to be able to serve the customer the way that we want to serve her and do it in a way that I felt like was right for our financial situation, I think has served us well. But that being said, there's a lot of investments that we've made, men's and plus size, and there are probably other investments that we'll choose to make in the future.
Stitch Fix had almost $1 billion in revenue over the last year. They are an online personal styling service, of which there are many now, David. What are the prospects, you think, for Stitch Fix?
They're huge. I actually think this is another one of the really heroically good companies of Silicon Valley. I think Katrina Lake is got to be, who I don't know, I would like to get to know her. She's clearly a spectacularly good CEO. She made a really big bet early on artificial intelligence, and interestingly, in this company's case, it has really helped them grow and even grow their employment, despite the image that we often have that AI and robotics and automation are going to cause jobs to go away. They have 3,400 stylists who basically work with the recommendations that come out of the AI when making the final recommendations to the customer. And it's an amazing business. The customer doesn't know what they're going to get, but they end up buying $1 billion worth of it just because the company figures out to send them the right thing. It sounds like something maybe you are such a shopper, Emily, you wouldn't like, but it is a really good thing for a lot of women and increasingly men as well.
It has a lot of fans out there. Bill Gurley, interestingly, also an early investor in Uber, it was an early investor in Stitch Fix. And one of the most fascinating stories about Stitch Fix is that they got a lot of no's from investors early on, and it was a difficult story to tell and for investors to believe in. Do you think that Stitch Fix is long-term sustainable, given what we've seen happening with other subscription service companies?
Well, the reason I think it's sustainable long-term, again, is the intelligence with which they're approaching the automation part of their business. I mean, this is the future of business, the intersection of AI and human work. And I think as long as they continue both understanding that you've got to have human touch, but that software can help you make the right decisions, I think they can grow a lot. Amazing. They've only been around since 2011, and they're $1 billion company.
David Kirkpatrick, we'll leave it there. You'll be with us again after the break. David Kirkpatrick, CEO of Techonomy. Coming up, Lyft made headlines this week with its $1 billion funding round led by Alphabet. We'll talk about the deal and preview next week's big tech earnings next. This is Bloomberg.
I'm Mark Crumpton in New York. You're watching Bloomberg Technology. Let's begin with a check of first word news. President Trump says the United Nations has tremendous potential, but that it hasn't been, quote, used over the years nearly as it should be. The president's comments came as he welcomed UN Secretary General Antonio Guterres to the White House Friday. Defense Secretary James Mattis met Friday with Senator John McCain, chairman of the Armed Services Committee. Lawmakers are demanding answers 2 weeks after an ambush in the African nation of Niger killed 4 U.S. soldiers. Both men spoke privately in the senator's office. McCain, frustrated with what he says is a slow response for information from the Trump administration, has threatened to issue a subpoena. White House Press Secretary Sarah Huckabee Sanders is criticizing a Democratic congresswoman who clashed with the president over his condolence call to a military widow. On Thursday, White House Chief of Staff John Kelly rejected claims that the president was disrespectful to the family of Sergeant LaDavid Johnson, who was killed in Niger. On Friday, Sanders also was asked about complaints from family members about the president's call.
Certainly, if the spirit of which those comments were intended were misunderstood, that's very unfortunate. But as the president has said, as General Kelly said, who I think has a very deep understanding of what that individual would be going through, his comments were very sympathetic, very respectful, and that was the spirit in which the president intended them.
The British Prime Minister Theresa May says there is still some way left to go on Brexit talks after little apparent progress at the European Union summit. She spoke Friday in Brussels.
I'm positive and optimistic about where we can get to in relation to the future partnership that we want with the European Union, because it's not only in the interests of the British people, it's in the interests of people across the remaining 27 members of the European Union as well.
May's EU partners have agreed to begin discussing what their joint position should be on future relations and trade so they can be ready if sufficient progress is made before the next formal summit in December. French President Emmanuel Macron says despite the positive signals that came from those Brexit talks in Brussels, quote, "We are far from having reached the necessary financial commitments before we can move to phase 2 and start talks on a future trade relationship." Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton in New York. Back to Bloomberg Technology.
This is Bloomberg Technology. I'm Emily Chang. Alphabet sides with Lyft in the showdown with Uber. Alphabet's Capital G investment arm is leading a $1 billion investment that values Lyft at $11 billion. Remember, Alphabet's Google Ventures made a big investment in Uber years back, but of course is now embroiled in a bitter lawsuit with Uber. Joining me now to discuss the news and preview earnings for next week, Bloomberg Tech's executive editor Tom Giles and David Kirkpatrick, Techonomy CEO, our guest host for the hour. David, I want to start with you. What's your take that Google is now backing Lyft after all these years, and knowing that it also has a big stake in Uber?
Yeah, they seem kind of fickle, or you could look at them as just hedging their risks and saying, hey, we believe these ride-sharing businesses are going to just grow like crazy, and we want to have a hand in both. And I think it's not foolish. Obviously, they're now making a bigger bet on Lyft than on Uber, and they've had such visible and ongoing conflict following their earlier investment in Uber. It's there's a little bit of sort of emotional subtext here, but I actually think both companies will be good investments long term, and I suspect they do too.
I interviewed the president of GM earlier this week, Dan Ammann. GM also made an investment in Lyft and is now talking with Uber. Take a listen to what Ammann had to say.
A lot of options in terms of how we can go to market. We can go to market, through our own network capability. We can go to market through different partnerships. So I'd say all options are open at this time.
So that was in response to a question, Tom, about whether they would ever partner with Lyft, whether they would buy Lyft, how they might capitalize on Uber's weakness. And he's saying all options are on the table. And
right.
We know now that they are talking with Uber.
I think what you're seeing is these big companies, big conglomerates, SoftBank, Alphabet, GM, not a conglomerate, big auto company. They want to pick a winner. They want to pick a winner in ride hailing. And it really has come, particularly in the US, it really has come down to Uber and Lyft, as we've known for a long time. But the fortunes of these companies have changed very, very dramatically. Uber, as you know, has gone through all of this dramatic upheaval over the last several months. The new CEO trying to find his footing. Big legal battle between Uber and Alphabet. So Alphabet, Google really can't stay behind Uber. You also have the possibility of Lyft somehow cooperating with Waymo in various ways down the road, as you see kind of Lyft avoiding getting into self-driving. Maybe that's their vehicle, no pun intended, into that area of the business. So I think there's a lot of potential for Waymo and Lyft, and I think this is Alphabet really putting a stake in the ground, saying we're backing Lyft. This is the one we think, this is one we're champion. SoftBank, on the other hand, really putting its weight behind Uber, the rival there.
Meantime, we've got a raft of tech earnings coming up next week, including Alphabet, as well as Microsoft, Amazon, Twitter. What are you watching?
Big week. Amazon, we're going to see the first full month of Whole Foods. How much of a difference does that make to the bottom line? I think an even more important business is going to be Amazon Web Services. They continue to be a real contender in that field, one that, really kind of dominating it in many ways. Although Microsoft and Google also want to take a big bite of it, they're continuing to put pressure on Amazon. I think you're going to see Amazon Web Services continue to run away with it, and I think that's going to make a big difference to their bottom line. That's Amazon. Google and Facebook. Facebook's a little bit later. Google, the story for all these new businesses that they're getting into, it's really down to digital advertising, and you're going to see another big gain in the global digital advertising market. Google and Facebook dominating that. It's just another matter of how much is this duopoly taking of this important and growing market.
This, as they're facing some, regulatory issues and preparing to testify before Congress. David, you recently wrote a column, Amazon, Facebook, and Google, too big to tolerate, too big to stop. I'm not sure I've heard you be so outspoken about the size of these companies before.
Well, I think as time passes, it becomes more and more evident that these companies are an entity that we've never seen before in any economy. It's kind of a new phenomenon in capitalism that companies would have such an amazing global weight, across the economy of the planet and so much power, and yet be so completely ungoverned by any entity aside from their own management. I think that is fundamentally untenable. I think each company's situation is slightly different. But I do think that we are going to see over the coming years, maybe decades, probably less than decades, a major shift in social attitudes where it's going to increasingly be evident that these companies have to somehow be governed by society, not only by themselves, because they are utilities of the classic sort that cannot be allowed to make decisions entirely on their own. It's too important.
Meantime, Tom, Twitter's been in the spotlight in particular around, harassment, sexual harassment issues. It came up with the Rose McGowan situation earlier this week. The company is saying we are going to be more transparent about this. We have failed. We need to do better. Do you think they actually can and will?
I think they're less well equipped than the other companies for self-policing. They've got a bot problem historically. We've been writing about this. Selena Wang has been writing about this. Historically, it has not been in their interest to get the fake accounts off the site. They want this to be a marketplace of ideas. They want you to be able to have accounts on there that disseminate news, that send out alerts. These are not all like real people like you and me. So it's all historically that has been in their interest to get growth, and some of it has happened through these fake accounts. And so they've been very much late to the game in terms of getting them off the site. None of these groups wants to be really highly governed, highly regulated in terms of disclosures. Facebook has fought against that historically. I do think it's coming. I agree with David that we're going to see more regulation. The question is, how deeply is that going to affect their businesses? We've talked to a lot of investors in recent days who continue to buy into the tech thesis, and they say fundamentally it's not changing. You're continuing to see the growth, whether it's digital advertising, whether it's in the cloud, whether it's demand for iPhones. I mean, whatever it is, you're going to see regulation, but it's going to be around the margins, and it's not going to have, at least in the foreseeable future, a deep impact on the bottom line.
All right, Tom Giles, we'll leave it there. Twitter, though, saying they are taking a new approach by revealing more information about their workflow and how they are approaching this problem. We'll see if that yields a different result. Tom Giles, our tech editor, thank you. David Kirkpatrick, CEO of Techonomy, thank you as always for joining us. Quick disclosure, Bloomberg LP is developing a global breaking news network for Twitter. Coming up, we will bring you a conversation with Illinois Governor Bruce Rauner, how he plans to drive innovation in the Prairie State. That is next. This is Bloomberg. The state of Illinois has released a list of 10 potential sites they've pitched to Amazon, the tech giant's $5 billion second headquarters. The project could bring 50,000 jobs to the state. One of those sites is a planned 62-acre campus for innovation. Illinois Governor Bruce Rauner and the University of Illinois recently announced plans for the Research and Innovation Center known as the Discovery Partners Institute in Chicago. Earlier, Bloomberg's Julia Chatterley caught up with Rauner and started by asking why the Innovation Center would be the perfect choice for Amazon's second headquarters.
This is a very exciting new initiative we're undertaking with the University of Illinois. You know, we're fortunate. The U of I is one of the greatest research institutions in the world, and their students and faculty have founded dozens and dozens of the most successful companies, technology innovation companies anywhere in the world. Whether it's YouTube, PayPal, Yelp, Siebel Systems, Oracle, Netscape. Even Tesla Motors have been founded or co-founded by University of Illinois students. And what we're doing is helping expand the engineering school and the University of Illinois, both in Urbana-Champaign, in central part of the state, but also opening a major new facility and research institute downtown Chicago. So the pipeline of brilliant technology and computer science students are right here, right next door to where Amazon can use them both to recruit new employees, but also to research innovative new services and products.
It sounds absolutely fantastic, sir, but then I look at the finances of the state and I see that you're cutting financing for higher education, that you've got billions of dollars worth of unpaid bills, and I wonder just how you're going to pay for this. How are you going to pay for this?
Yeah, well, it won't be that hard because it's mostly going to be done with private donations. The U of I has just kicked off a $3 billion capital campaign, and we have many businesses who would like to partner with the Institute and with the U of I. So this will be privately financed fundamentally, and it's such an exciting initiative. Not only will the U of I be involved, but University of Chicago, which is another world-class institution, as well as Northwestern University, all here. We are the only metropolitan area, the region of the country that has 3 of the most prestigious, most elite research universities in the world. Harvard and MIT have transformed New England. Stanford and Berkeley have transformed California. Well, we have 3 universities who can transform Illinois, and we're going to make it happen. It's going to be very exciting.
So talk to me about what we've seen, because we've seen a recent succession of disappointments. We had the potential for a Foxconn factory. We had the Mazda-Toyota joint venture. This is 17,000 jobs that went to other states. So why will Amazon be different? And how do you go to Amazon again and say, guys, you know, don't worry about future tax rises as a result of the finances of the state here?
Well, I believe that we are far and away the best location for Amazon's next headquarters, far and away. And frankly, we're outstanding for any headquarters for a national, international company. With our people, our workforce, our location, our transportation network, our university system, which is second to none, O'Hare International Airport, there is no greater airport anywhere in the world. We have every attribute that Amazon's looking for, and I believe that we are going to win this competition, hands down.
So talk to me more about the finances. You have this big bond offering next week, $4.5 billion. What are investors saying, and how do you expect that to go?
Boy, the investors' response has been very strong. I can't comment too much. It's in process, so I won't get real specific. But basically, we're refinancing some bills. You know, when I became governor, there were many billions of unpaid bills. We had a huge backlog. And frankly, Illinois has been running deficits for decades. I came in, we're transforming the state government, making it much more efficient, effective, transparent. We've shrinked the cost of government. We've taken out hundreds of millions from Medicaid waste. We've got innovative new union contracts with 18 of our government unions based on merit pay and completely different work rules and management process. We're transforming state government. One of the things we're doing is to refinance those old unpaid bills, because many of those by law have to pay interest of 9% and in some cases 12%. Well, we can refinance that and save hundreds and hundreds of millions of dollars at lower interest rates by going to the bond market, and that's what we're doing right now.
Your credit rating's one notch above investment grade, above junk. Maintaining that investment grade rating clearly essential for the state. What more can you do?
Well, we're transforming the state, as I mentioned. You know, unfortunately, we've been financially mismanaged for 30, 35 years. I ran for governor as a business person. I'm a private investor, venture capitalist, private equity investor, and I came in to really shake up the system, transform the government, and we've achieved major changes in a very short period of time. Still work to be done, no question, but the combination of good financial discipline, as well as restructuring our government and shrinking the number of levels and layers of government we have across the state of Illinois, and then very much cutting our bureaucracy and our red tape and our regulations.
Illinois Governor there, Bruce Rauner. Coming up, Casper's partnership strategy after a deal with American Airlines. What others are in the pipeline? We'll sit down with CEO Krim. This is Bloomberg. SoftBank is said to be planning a second fund that could be even larger than its $100 billion Vision Fund. The company, which hasn't finished raising money for the world's biggest tech investment fund, is floating tentative plans for a second Vision Fund that could be about $200 billion. This, according to the Wall Street Journal. CEO Masayoshi Son told the Nikkei Business Daily he hopes to launch a new fund every 2 or 3 years. Well, Casper, the startup that began selling its mattresses direct to consumers online, announced a partnership with American Airlines last month. The startup provides pillows and blankets, among other items, to customers sitting in first or business class. Selena Wang spoke with CEO Krim at the WSJ D-Live conference and asked if the company is looking to add more partnerships.
We look at any touch point that someone might have with sleep, and unfortunately sleeping on an airplane is often a very difficult undertaking, and so we saw the opportunity to work with American Airlines, improve the way that people can sleep on planes, and we think that's an amazing partnership. And so we'll continuously look at other areas where customers have intersections with sleep and see what we could do to help improve that.
What are some examples of that?
Well, hotels are another one. So when you're traveling for work or pleasure, the way that you sleep obviously impacts the quality of your trip or your performance. And so we think there are opportunities to improve the quality of sleep at hotels as well.
Now, online mattress sales have boomed in recent years to many observers' surprise. And where would you say your market share is right now, and who would you say you're taking market share away from?
So we still think that the online percentage of share within the category is relatively small. It's grown tremendously fast since we launched our business 3.5 years ago, and we think that that growth will continue. And we think we're pulling a lot of share from the traditional brick and mortar. The idea that customers have to go into the mattress store that is seemingly on every corner, we think is antiquated. And we're hoping to help educate consumers that that paradigm is a paradigm of the past and that we're a better, smarter way to buy mattresses and other sleep products.
So Casper's cut out a lot of those inefficiencies by going direct to consumer. Could you give us some color on what the supply and distribution model looks like?
Sure. So direct to consumer means that we know our customer, we know what they want, we know if they want delivery around a certain time. A lot of people are buying these products around moving homes or having kids out of school, things like that. And so it lets us work throughout the entire supply chain to make the experience as amazing as possible. So we work with our manufacturers to design products to our spec. Those products are constantly being improved based on feedback and intel we're getting from our customers. We love that one-to-one relationship with customers, and now that we have that at scale with hundreds of thousands of customers, we're able to really hone in the products, make them incredibly comfortable, provide the best night of sleep possible, and do it in a way that is easy and unlike anything you could have done before.
Now, Casper is primarily a digital brand, but you have this partnership with Target now, and it's actually available in many brick and mortar stores. So how important is that offline sales channel? How have sales been?
Sales have been phenomenal, and we've never talked about ourselves as a digital-only brand. We certainly started digitally first and focused on building our .com experience, but we always knew that customers are out there and want to touch and feel our product. They want to lay on the product, and so we think that's an incredibly important part of the overall customer journey, and we're excited to continue to do more and more things offline.
So where do you see this partnership with Target going long term?
So long term, we think that Target will give us a meaningful new customer base to get in front of. They'll help build awareness in front of the 30 million guests that go through their doors a week. But we see Target as one part of the overall pie for us to go offline. We're also doing more pop-ups that we do on our own, where we get to talk to our own customers and service them and make sure that we're creating the best experience possible. And you'll see us do more of those as well.
So Bloomberg News has reported that Target had considered acquiring Casper. So what do you make of that, first of all? and where do you foresee the company?
So the conversation with Target was great in that we discussed with them our business. We had been working on the commercial arrangement with Target for some time, and we got to know the management team very well, and they got to know us, and it was just a meeting of the minds where we both saw the opportunity within the consumer landscape. Sleep is becoming an important part of the consumer journey. We think it's becoming the third part or the third pillar of wellness next to active lifestyle and healthy eating, and this was exactly in line with Target. So when Target asked us what could they do to help us and grow our business, we decided the best path forward was for them to lead our Series C round of financing.
So is the goal then to become an independent global sleep brand, or do you think it could fit very nicely into some larger corporation?
No, we think that we have a very large and bright future ahead of us. As I mentioned, we're only 3.5 years into our journey. We just launched the business recently, so we're still a very young company with very big ambitions, and we think we have a lot of work to do to build our brand and to build the next great global consumer presence.
And speaking of a global consumer presence, what areas are next?
So we have a European business that we launched about a year ago. We've always talked about building the next great global brand. So Europe's been doing phenomenally well. You can buy Casper products in Germany, Switzerland, Austria, the UK, and France. We'll continue our European expansion over time, and we'll continue to build more progress in the US and Canada as well. And
what about Asia? Any inroads there?
Yeah, Asia is an exciting market. The market in Asia is changing very quickly. Every country is a bit different, and we'd love to enter there, but no immediate plans.
Casper CEO Philip Krim there, along with Bloomberg's Selena Wang. And that does it for this edition of Bloomberg Technology. On Monday's show, we will be speaking with Congressman Rauner from California about the role of tech firms and if the big tech giants have gotten too large. And a reminder, we are live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 5 p.m. New York, 2 p.m. in San Francisco. That's all for now. This is Bloomberg. Have a great weekend.